Joining us now is Yang Tang, co-founder and CEO of Arch Indices. Yang, thanks so much for joining us.
Hi, thank you so much for having me here.
It's great to have you. So I was taking a look at your notes, Yang, and you say now is a good time for investors to reposition an income portfolio. Tell us why now.
Yeah, so I think, if you look at the last 3 years, the income products have had a horrible run. That was largely driven by the Fed raising interest rates from 0 to 5%. Given where we are at the late cycle stage, if you look at the hard landing and the soft landing scenarios, both scenarios involve two things. The Fed getting to the 2% target, it's a question of how they get there, and interest rates will move lower when they get there. In one scenario, risk-on assets such as stocks does relatively well. In the other, they don't do well. But in both scenarios, you're looking at a decent price appreciation and good current yield in income products. So as investors go into the end of this year, with one, the tax loss harvesting potential in income portfolios, they want to reposition their portfolios into the income products that will provide good current yield and have price appreciation as interest rates rally.
Okay, so we'll talk about how to do that in just a second, which will incorporate your new ETF as well. But when I think of an income portfolio, I think of a more defensive strategy. Is that, can I glean that you're maybe cautious about this market looking forward, especially into next year, if you're going a bit more defensive?
Oh, very much so. I think one of the biggest investor debates this year has been reconciling the very soft leading economic indicators and the relatively strong hard economic data. If leading indicators were any signs, we would have seen a recession by now. But given the current economic environment, the tight job market, as well as the amount of monetary and fiscal stimulus done during COVID, this recession is almost a waiting for Godot moment. It's inevitable that the economy will go into a recession. The only matter is how deep it's going to be and how much pain there will be for investors.
Okay, so your Arch Indices Absolute Income ETF, ticker symbol VWI, aims to maximize income while minimizing volatility. Tell us how it does that.
Sure. So it's a dynamic, balanced absolute income portfolio we launched as an ETF in October of this year. Arch Indices does this by constructing a portfolio of assets with high performance ratio, which is yield relative to volatility, that do not move together. So our process seeks to take advantage of divergence among stocks within the sectors of the stock market, and between stocks and bonds. The ETF currently holds 109 individual dividend-paying stocks and 8 bond ETFs. Our portfolio construction process is passive, and it's called variance optimized indexing. It's a rules-based, transparent approach that dynamically rebalances with changing market conditions. VWI currently rebalances every quarter. This process takes into account each asset's yield, its volatility, and the correlation to the rest of the portfolio.
So 109 dividend stocks, 8 bond ETFs. Can you be any more specific about your top holdings right now?
Sure. So our process is really a screener approach. We have 550 available stocks and 12 bond ETFs we selected to represent different parts of the bond market. The top holdings right now are Philip Morris and British American Tobacco. The process really to pick the stocks is a minimum 2 billion market cap, a minimum 3-month 20 million average daily trading volume, a minimum 3% dividend yield, and a minimum 5-year of dividend history. So the idea is you have a large pool of assets and you're looking for the optimal portfolio that generates the most income while minimizing volatility.
I have to ask, because you say a recession is inevitable. Well, this is the most forecasted recession I've ever had in my lifetime, I think, that just hasn't come. What happens if this economy remains resilient and we don't enter a recession next year? Then what?
Well, this is actually a great product in both scenarios because it has high current income, low relative volatility. It's a dynamically rebalanced portfolio, and it's 81% dividend stocks. which provides potential for capital appreciation. I think one of the hardest things about being an income investor is that many income products have negative convexity. There's always much more downside than upside. If you think about, say, buying a mortgage-backed security here, a mortgage-backed security at 7% is very likely to be refinanced when it goes down to 3%. Owning a basket of dividend stocks and bond ETFs kind of offsets that because of the potential of capital appreciation and the high current income.
Okay, we'll leave it there. Appreciate you shedding some light on this new ETF and strategy. Yang Tang, co-founder and CEO of Arch Indices. Thanks so much.
Thank you for having me.